Here's a brief history to how it all began. Before our history train leaves, kindly note that, when we say brief, we mean to cut out all details that would make this section unnecessarily bulky. We intend to serve your brain the knowledge required for this course. Here goes our history train. A brief history into the foreign exchange market. The first form of exchange was the barter system. It is the oldest method of exchange known to man and began in 6000 BC. Under the barter system, goods were exchanged for other goods. The system then evolved, and goods like salt and spices became popular mediums of exchange. This was so because food was a requisite to survival. Therefore, making it a form of exchange was not just logical but very sensible. This is the first ever form of foreign exchange. Then there was a transit into creating other forms of value for exchange. So in this developed system, I would be able to exchange a substance of value to you in order to receive spices in exchange. Value was determined by service and then by treasures. Treasures like precious oils, rare spice, fast horses, precious metals, precious stones, and then golds, silvers, and the like of them were also brought into the forms of exchange as time kept advancing. And as we know, value changes over time. As time went by, gold coins became widely accepted as a medium of exchange. The Arabian spoken of here is far back as early 6th century BC, but they were impractical because they were heavy. Then again time went by, and it evolved in the 1800s when countries started adopting the gold standard. Then foreign exchange market was backed by the gold standard at this point, and during the early 1900s. Countries traded with each other because they could convert the currencies they received into gold. However, this could not hold up during the World Wars. Then came the Bretton Woods system. Oh, did we forget to mention that slaves were also at some point a medium for exchange? Let's rush back to the Bretton Woods system. After the slave trade era, the Bretton Woods system became the second big change in the advancement of the foreign exchange market globally. It happened at the end of World War II, and it was a big change. Then the Bretton Woods Agreement was set up to make the world's economy more stable so that it could grow again. It tried to do this by setting up a flexible pegged foreign exchange market. Now, here is what an adjustable but pegged exchange rate is. An adjustable pegged exchange rate is one in which the value of one country's currency is fixed against the value of another country's currency. Foreign countries would fix their currency rates to the US dollar in this case. Oh, did we not mention that the Bretton Woods Agreement was about the United States? Because the United States had the world's largest gold reserves at the time, the US dollar was tied to gold. As a result, foreign countries transacted in US dollars, which is also how the US dollar got to be the world's reserve currency. Because there was not enough gold to back the quantity of US dollars in circulation. The Bretton Woods Agreement finally failed to peg gold to the US dollar because the amount of US dollars in circulation expanded due to increased government financing and spending. President Richard M. Nixon dissolved the Bretton Woods Arrangement in 1971, allowing the US dollar to freely fluctuate against other currencies. Following the Bretton Woods Accord, the Smithsonian Agreement was signed in December 1971, which was identical to the Bretton Woods Accord but allowed for a wider currency fluctuation band. The US dollar was tied to gold at $38 per ounce, causing the currency to depreciate. Other major currencies might fluctuate by 2.25% against the US dollar under the Smithsonian Agreement, and the US dollar was anchored to gold. In 1972, the European community attempted to wean itself off of the dollar. West Germany, France, Italy, the Netherlands, Belgium, and Luxembourg formed the European Joint Float. Both agreements, like the Bretton Woods Accord, committed flaws and collapsed in 1973. As a result of these failures, the free-floating system was officially adopted. Then came the Plaza Accord in the early 1980s, and after that we then got to the era of internet trading in the 1990s, which changed everything. Today the Forex market has grown to be the largest in the world. There is a daily turnover in the Forex market of more than $6 trillion. Why is this history important? Because it helps you build a solid foundation of the idea behind the financial market and foreign exchange generally. That was a quick run-through of centuries-old data of how the Forex market came about. It is not mythical, not illegal, and it is as real as the world's economy. The Forex market is built on the world's economy, thereby making its foundation stronger than any other financial institute out there. That wasn't as brief as anticipated, though. But let's keep moving, and we promise to keep up next time. Our history train has arrived at its destination, and we would like you to have a bit of the crisp Forex Guru's feel. We are going into Forex lingua.